to the Inspire Wealth podcast with Prof M, where we dive into the world of real estate investing and wealth building strategies. I'm your host, Mallory Meehan. I'm a real estate professor, attorney, and seasoned investor here to guide you through the ins and outs of creating wealth through real estate. If you're looking to take your real estate knowledge to the next level, don't forget to subscribe to stay up to date with our latest episodes and offerings. Welcome to another episode of Inspire Wealth. I am your host, Prof M, and today I am joined with me by Jon Connors, who is a fellow tax enthusiast. So I'm really excited about this episode. Jon, thank you so much for being on the show today.
Thanks, Mallory. Appreciate having geeking out on taxes and real estate.
Love it. Love it. So, Jon, why don't you tell us a little bit about yourself? Tell us how you got into tax, and then we're going to dive in and try to educate our audience on some tax strategies that they can employ, because tax season is just right around the corner. And so I think these topics are really, really relevant right now.
Yeah, well said. It's tax strategy season for
Absolutely.
starting in December, but not everybody knows that one, you know?
Exactly.
Okay, so I got into taxes actually, just to be fully transparent, by being a tax degenerate. I got stuck with a big bill and multiple years of not filing because of activism. So I was basically trying to fight the student loan issue in court, and I went 10 years without filing, and I had a six-figure bill that I'm still in negotiation with the IRS to reduce. So ultimately, you know, I mean, I have a master's in finance from City University of New York, Baruch College. And I just realized as years of activism had made me really attuned to the impacts of policy. And taxes are applied policy combined with financial acumen. It just makes sense.
Mm-hmm.
So and as we were talking offline, I also had a bit of an issue with the man thinking the IRS was out to get us. And I had an absolute realization in studying the tax code and using AI in particular to do it. Because the tax code, for those of you who don't know, I think is more pages than the Bible and all works of literature and all the great works of literature of the 19th century combined. So it's a beast.
Yeah.
And it's a quagmire of all different interest groups. And so it's actually, in my opinion, somewhat knowable nowadays with AI assistance. But without AI, I mean, I can't imagine. It was, I think, the only subject of law which the lawyer wouldn't get in trouble if he didn't know the whole thing.
Right.
You know, because the tax law is pretty intense.
It is. It is. Okay, Jon. So most of our audience maybe has a home that they own. Maybe they don't. Maybe they're looking at an investment property. So what I want to talk about first is let's talk about strategies and opportunities that they have to save money in taxes when they're looking to purchase their personal residence, so their personal home.
Okay. Personal homes, there's less leeway and wiggle room than there is in an investment property.
Okay.
The best, I mean, ultimately, we write off personal home strategies. I'm just writing it into Claude right now to see what our AI system will say. But basically, so you get to write off salt taxes, state and local taxes.
Mm-hmm.
So, you know, your property tax, your mortgage interest, but property tax, state and local taxes, property tax and sales tax combined can only be written off up to $10,000. You used to be able to have a much larger chunk than that.
But that's a very hot topic of discussion right now, right?
It's a very hot topic of discussion right now, partly because some people are frustrated by that and they don't realize the tax benefits that came with the Tax Cuts and Jobs Act of 2017.
Mm-hmm.
Tax Cuts and Jobs Act was Trump won. He pushed that through. And it was very favorable to real estate investors. It was less favorable to real estate owners who own single family properties as their own primary residence.
Yeah.
What happened is you either itemize or standardize deductions at the at the point of filing, and the Tax Cuts and Jobs Act made it where 90% of people took the standard deduction because they made it very appealing for us.
Mhm.
And so that means that people who used to own property, own single family homes, and get a very big tax benefit lost that benefit.
Right, right.
So there's
Well, and
definitely some.
I think the biggest issue with the SALT tax limit is the people that are in states that have higher property taxes in general. So
Long
the
Island.
state to my east, New Jersey,
Oh
has
yeah.
some of the highest property taxes across the United States. And
Oh yeah.
so, you know, you own a property in New Jersey compared to right across the river in Philadelphia. And you know, it's a completely different story. And so people are claim, and I mean, it's a fair point because property taxes are a regressive tax. They're not a tax that's based on your income. It's strictly based on your
Use
property
tax.
value. What's that?
Yeah, it's an asset use class.
Yes, right.
Yeah,
And
yeah.
so you know, what do we do? Do we allow states that have higher property taxes to write off all of that? Because is it fair to have somebody, let's say in Pennsylvania, who only has property taxes of 4,500 versus a very similar home in New Jersey that has property taxes of 14,000, you know? And so the discrepancy there, I think that's where a lot of the tension and a lot of the arguments are focused on.
Well said. So what we're talking about is federal tax law at the moment. Some states didn't follow the federal tax law changes, and they still allow you to write up, especially the high tax states. They still allow you to write off your high tax bill on the state tax side.
Hmm.
That said, if you do have a $14,000 bill, that stinks. That's tough,
Hmm.
and you can't write the whole thing off.
Right,
It's an issue.
right.
Um, what's happening is people are voting with their feet and they're moving out of those states,
Hmm.
not just because of the tax issues, because the cost of living crisis as a
Yeah,
whole,
absolutely.
which that includes it. So
Okay, so we talked about salt tax. So if I own my own home, which I do, I can write off my property taxes, and
mortgage
my
interest.
mortgage interest
Yep.
and sales tax up to what was the threshold?
Well, so mortgage interest isn't included in the salt tax
Right,
bucket.
right.
It's an itemized deduction. So
So your
salt, state
property
and local
taxes,
taxes,
local
and your sales
taxes,
tax,
yeah.
$10,000 is the cap.
Okay, so $10,000 is our cap, but we do get to write that off. So that does help us as a deduction and lowering our taxable income. So I own
Only if it's bigger than the standard deduction.
right, right. If you're not going to take the standard deduction and you choose to itemize, that's a benefit.
But like I said before, 90% of people find that it's more beneficial to take the standard deduction since it was increased with the Tax Cuts and Jobs Act. Because
Right,
the government is trying to incentivize us to do things. It's trying to incentivize us to have less complicated tax returns. Less complicated tax returns means the IRS can concentrate on just the 10% of people who itemized as audit targets because standard deductions are less, like, there's less wiggle room to play.
right. Okay, so then why own your own home?
Well, one of the worst taxes out there is called capital gains tax. And capital gains tax occurs at the sale of a property. It's the difference between your purchase price and your sale price.
Mhm.
And actually, if you have a primary residence, you have a capital gains exclusion up to 250,000 bucks if you're single, and up to 500,000 bucks if you're married filing jointly. But you have to live in your home for at least 2 of the last 5 years before selling.
Mhm.
So that is huge. That is
Mhm.
huge. That's if you're in the 500K realm, you're close to a 20% gain. I think 519 is the cutoff this in 24. So you have either 15 to 20% that you would be taken off the top that the government says, no, this is your primary residence. You're probably going to roll that into another primary residence. So ultimately, we're going to allow you to have that gain tax free.
So let's say I'm looking for my first property. And you know, I find it in an area that I feel properties are going to start appreciating, they're going to start growing in value. So I buy my first property at, let's say 300,000. Okay. So,
Tulsa. That's like Tulsa prices, not Jersey prices.
well, no, I'm in Pennsylvania, so that's still
Okay,
Pennsylvania.
oh, rock on. Yeah,
Yeah.
yeah. Rock on.
So I buy my first property at 300,000 and I make some improvements and I live in it for 2 years. I then am like, okay, let's buy a new one, right? Because now I can sell it at an appreciated rate. I put in
Yeah.
some improvements. Let's say I sell it for 400,000. I have $100,000 that you're telling me I have no tax on.
Yes, exactly. You have income that you don't have to be taxed, which is
So
great.
then why doesn't everybody just live in a house for 2 years, make improvements, and then move on to another house?
That is a brilliant question. So not everybody understands how to navigate the tax code to riches. What
Mhm.
you just said is to navigate the tax code, the rich riches strategy. That would be if you looked at the tax code as a way to make wealth. Another reason is because it's expensive. You know what I mean?
But you have
But
to pay closing costs, so you have to take that into account
exactly,
too.
exactly. Yeah.
And the cost of moving and like,
Yes.
having to change your address and having to change your
The
utilities.
the annoyance of it for
Yes.
sure, for sure.
Yes.
Yeah, some
But
people want a home for as a forever home, but what you just said, minus the transaction costs, if you're hooked up with some like private equity cash buyers or something that reduce the transaction costs of the homes, that is an incredible strategy
mhm.
to increase your wealth tax free.
Yeah, I mean, because you could essentially, like, let's say somebody didn't want to work and they were able to make $100,000 on the sale of their property, they could probably live off of that for 2 years.
I know, I know, I know, but most people are in the game of increasing their status.
Yeah.
Usually, when you have $100,000 gain, for the most part, if people I know will roll that into their lifestyle costs. You know what I mean? They want the bigger home. You
Yeah.
know what I mean? They want the nicer thing or nicer things.
Yeah.
But what you said is really an amazing strategy.
Yeah.
Um, things open up a little bit more when somebody is a property investor rather
Okay.
than a home acquirer for their own personal gain.
All right. So let's say, I own my own home. I'm not owning my home to necessarily save money on taxes, right? I'm owning my own home because I'm choosing to own it. I'm choosing to make it my own and not rent. So now I'm in the market and I'm like, okay, I have a 401k, but I don't know what's going to happen with the stock market. I don't want to put my trust into other companies. I want to put my trust in myself. I want to invest in real estate. So I want to go out and I want to find my first investment property. Now I have a W-2. I
Yep.
have a job that's paying me a regular income, but I pay a lot of taxes
Yeah.
and I want to try to like eliminate some of those taxes, if not all of them. So tell me some strategies that somebody could deploy, especially if they're a high income earner. I think that that's really important to understand. I mean, obviously anybody can do this, but those that have high income, especially professionals like doctors, attorneys, accountants,
Yeah.
CEOs, business people, all of those types of individuals, they have very large tax bills. And so how can we help them lower or eliminate those tax bills?
Great question. So first, we have to talk a little bit about the tax code and its ever moving nature.
Great. Let's do it.
So in 20 to 22, there was the greatest strategy called the short-term rental tax loophole, which is less beneficial now because accelerated depreciation is decreased this year.
Mhm.
So it's still doable, but if you don't buy a property by the end of the year, you miss out on the benefits. So I just want to at least note that the tax planning and planning for investments is like sometimes trying to catch a waterfall.
Mhm.
You know what I mean? You can catch pieces of the waterfall, but ultimately there are things coming upstream that you can't always anticipate, and we don't always have people in charge that are advocating on our behalf. So things come through the pipeline that are unexpected.
Mhm.
So one of the benefits, so Trump was a real estate investor himself. So he did pass the most favorable real estate investment legislation, I believe, in the history of America.
I would totally agree with that. Yes.
And with that, he allowed accelerated depreciation to be written off at the almost it was 100% for the first 2 years. So it wasn't exactly dollar for dollar 100% of property cost because you had to do a cost segregation study and break your asset up into pieces. The floor, the HVAC system, the cabinets, the decking, the outside landscaping, things like that. But you'd get a very high chunk of from 20 and 21, you could potentially write off on an accelerated basis, like 85% of your property value in the first year.
So let's back up a second and
Sure.
for those who don't know what depreciation is and what accelerated depreciation meant, as well as a cost segregation study, let's maybe pull
Yeah.
that through just so that we're giving everybody
Thank you.
all the
Thank you.
information they need. So,
Thank you. Thank you,
what
Ryan.
is depreciation?
So depreciation is like a car depreciates in value. We buy a
Mhm.
car, you drive it off the lot, it's worth less money almost immediately.
Correct.
With a home, same thing, though a home is an asset that appreciates different than a car over its life, hopefully.
Yes.
But that said, your roof is deteriorating.
Mhm.
Your your walls are getting damaged. Your
Yeah, you're
floor,
using it. Yeah.
using it,
Hmm.
and there's replacement costs.
Hmm.
And the government allows us to write off over a period of years. What straight line depreciation is, I think, 26 and a half years, 27 and a half years.
27 and a half. Yeah.
Thank you, thank you, thank
You're welcome.
you. I always need my AI to get me the exact thing. So Mallory's the AI today.
27 and a half years for single family and up to 4 units, and then commercial property is 39 years.
39. Yeah, yeah. Yeah. So that's you're dividing the cost of the asset that you're depreciating over that time frame.
Minus the land value.
Because land can't
Land
depreciate.
can't
Land's
depreciate,
never going
right?
to depreciate.
Right.
Right, right,
Always
right,
going to be there.
right. So what we have is the straight line depreciation is beneficial,
Hmm.
but accelerated depreciation, you can write off almost the entire chunk of everything except the land value immediately.
Hmm.
So
So like year one, I buy property and I had a lot of closing costs. I had a lot of improvements that I had to make. So I want to be able to maybe get back some of that, or at least like not owe money in taxes. The accelerated depreciation was definitely something that I could have taken advantage of.
all the way through this year, so it was 40% is available this year through
Got it.
2025. The
Okay.
last year was 60, the year before was 80, the 2 years before were 100.
So do
So,
you think, and this is kind of a little bit off topic, but do you
sure.
think that the new administration is likely to bring back that benefit like they had in 2017?
Yeah, if I were to put on my prediction hat, tax, there's a mandate for the new administration to get tax benefits passed within the first 100 days of the administration. If I were a predictor, which I know my Magi hat on right now, so don't
Yeah.
really believe as much as you believe in Magi.
Yes.
I would say that we're going to get another accelerated depreciation bonus, and the real estate industry is going to pop because it's going to bring the investor desire and appetite up because that 100% depreciation for those that missed it and know, we're like, oh my God. And then going back, it was a long story. I guess I have to tell about the cost segregation study first
Yeah.
before talking about the short-term rental loophole
Yeah. I
because
think that's probably beneficial.
okay, rock on. So in order to get this benefit, you had to do a study, which the IRS gives good guidance on it, and we do it at LessTax US for customers. And sometimes engineers come in. You basically just break your home up into chunks,
Hmm.
and then you depreciate per chunk. Per like the driveway is going to depreciate different than the landscaping. It's going to depreciate different than the vinyl siding on the outside of the home. Depreciate different than the glass doors, than the shingles on the roof. And once you do one of those studies and you purchased a home, you can now accelerate the depreciation. And I think we're going to get another 2 years, 100% in 25 and 26.
Okay. Well, here's hoping you're right, Magi. Because I think that the real estate industry truly does need some sort of a push or some sort of just, some ammunition to help spur some sales and spur some growth potential, because the interest rate market has just basically killed
Eating growth.
a lot of deals because they have no room of making any sort of cash flow on a lot of these investment properties.
Well said. Nobody who has a 3% home wants to sell.
Exactly.
And because you're just eating any appreciation of your asset by the higher price of the follow-up mortgage.
Mhm.
So,
Yeah.
but to go back to your really good question of how does a doctor or a lawyer or a high income, my father, I think paid 300K in taxes at his highest tax year, and as a W-2 worker. And that is insane
$300,000 in
in
taxes.
taxes. I think
1 year.
yeah, in the same number 2 years in a row of his highest earning years. And so for me, I don't believe that short-term rental loophole was available at that time. So what happens is, to go back now. So let's say you're a W-2 worker and
Mhm.
you're an investor in real estate. Typically, your active wages cannot be offset by your passive real estate activities.
Correct.
And the only way you can magically jump from active to active is either you are a real estate professional, which you have a number of hours, I believe 1,000 hours. You have to prove that
750.
you're the best, Mallory. You rock. Well, 750 hours. So that's a lot of hours for a person who's working already as a doctor or lawyer. They probably
Mhm.
aren't going to hit that.
Right. Right.
Short-term rental loophole. Oh, let me plug in my phone real quick. I mean, my computer. The short-term rental loophole is allowed. Oh, let me just do this. I'm excited because it's the most exciting part of the tax code, to be perfectly honest. So, short-term rental loophole allows you to go from a real estate activity to a trade business. And that makes it where it goes from a Schedule E reported passive real estate activity to everything, including that magical depreciation, which is not really money out of your pocket right away.
Right.
It's a ghost expense. It's a future expense in a way. Gets written off as a active expense immediately against your W-2 wages. So there are clients of mine who would have had a high tax bill that converted that money instead to real estate. And it was not exactly a dollar for dollar investment, a dollar in, a dollar tax saved,
Mhm.
but it was an enormous benefit for the high earner. That is the biggest opportunity in real estate. Is, let's say the Magi prediction comes true, the high earners acquiring short-term rental properties. So you run a trade business for 2 years, you get the depreciation benefit. It doesn't even matter if your property is cash flow positive, because the tax benefits are so lucrative.
Mhm.
It'll reduce your W-2 income and W-2 tax obligation, and all that money you paid into the tax machine will come back to you. So it's
So let's break this down a little bit.
good.
So if I can't classify myself as a real estate professional and I want to have my real estate income and losses offset my W-2 income and losses, then I have to invest in a short-term specific rental, correct?
Yes. And here's the deal: 7-day average guest day
Okay.
or 30-day average guest day if you're cooking them breakfast. So the guest day is a lot lower than, and it's higher. It's higher overhead as far as time invested to run that business.
Mm-hmm.
So it basically makes the government classify you as a B&B, small B&B proprietor, rather than a real estate passive investor.
So if I am a high earner, then in what I would imagine, because I have short-term rentals, so I know how much work
Yeah.
it goes that goes
Yeah,
into
yeah,
this.
yeah.
And, that might not be appealing again to somebody who is a high earner, who has a lot of, time that they're not willing to give up. So I guess my thought would be the most advantageous market would then be to investing in like a beach property or something that has like on-site management that can basically run the business for you and
Well,
you
you
get the
can't get
benefit.
the short-term rental loophole if somebody else is running it for you. That's the game.
Got it.
If you, I mean, unless you're paying them in Monero or cash, which we would never recommend,
So you can't have a property manager and
and still take advantage of the short-term
still
rental
take
tax
advantage of
loophole,
that.
because you have to have your cutoff instead of 750 hours has to be 100 hours, and you have to be the one who works the most on the property.
Got it.
So they've made it where those of us who do invest in real estate, and where some of us in the short-term rental investment world have automated our processes where we can run it ourselves at 100 hours a year, which is basically 2 hours a week. You know what I
Yeah.
mean?
Hmm.
So it's annoying, but you're not doing the sheets.
Right.
You're not laundering the sheets in between. You can have somebody else do that.
You have a cleaning company come and do what they do.
You can have a maintenance person come and you fix the wall, but nobody can work on the property more than you,
Okay.
hours wise.
Now, is there a minimum number of stays that's required in order for your property to be classified as a short-term rental?
No, I believe it has to be listed on a short-term rental marketplace, and at least one stay is in my. I'm going to ask you this question because that's a great question. I've never been asked it before. For me, the threshold is that it's provable that they're listed on those sites, Airbnb, VRBO, sometimes even HipCamp, because some of my clients can take advantage of
Well,
reducing.
because what I've been seeing, and I think that the short-term rental market is changing, and there are some challenges with that, but um, especially in a place that has high seasonality, you can do short-term rentals and be very successful, but then in the off season, a lot of people are converting to this midterm or medium term rentals where it's more of a month to month thing. So my question would be, if I did have a short-term rental for, let's call it 6 months out of the year, but the remaining 6 months I rent it out on a monthly basis, does that disqualify me as having a short-term rental?
Yes. Yes, especially unless you're adding extra services to them. So the average guest stay has to be 7 days if it's just a traditional short-term rental where they're picking up the key code from you over the app and there's very little touch point.
Mhm.
It goes up to 30 days max if you're cooking and breakfast or doing their lawn,
But that's the average, right?
That's the average. Yes, of course, of course.
So like I'll give you an example. So
Ah,
here I'm in a college town, and people who come here typically are only coming here for the weekends. Okay. So they're
yep.
coming here Friday and they're leaving on Sunday. So my average stay is 2 days. So I could do 2 days in a 6 month period, but then rent on a month to month basis. And my average is still probably going to be less than 30 days.
Yeah, you need to make sure you look at because month to month adds up real quick. Because if
Well,
7 days,
and a month to month, it might be weekly, it might be, oh, somebody
weekly,
wants a
weekly, now we're
6 week
talking.
rental,
Weekly,
somebody
now we're
wants,
talking. You know
and
what I
it's
mean?
not like it's rented boom, 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 boom. It's gonna be like, oh yeah, so and so wants it for this chunk of time, and then there's a gap, and then someone wants this chunk of time.
Yeah, ultimately, it's managing the gaps that is the issue that you need to actively manage your property. That's where the government gives you that loophole.
Yeah.
So, yes, there's way to work it, and working with a professional like either Mallory or myself is a way to do it because there is nuance to it for sure.
Hmm.
If you have multiple properties, that's where the average can be massaged. You know what I mean? I think a little bit more easily.
Yeah.
If you're in um, if you're in one ADU, one tiny home in the backyard, you know, one 30-day stay can knock you out of the average 7 day stay pretty quickly.
Okay, so I just thought of another question that some people might have.
Sure.
So if I have my home and I decide that football weekends, for example, in a market that I'm in, I rent my home out on the weekends for football. Do I get to then classify my home as a business opportunity to take advantage of that tax hole?
So your home, meaning an extra bedroom in your home?
Maybe it's like a finished basement that somebody can, like that it's a separate unit, but it's still my full-time residence, but I rent it out on the weekends.
Excuse me. That is, then you'd have a percentage in short-term rental investment. It'd be a percentage of your home itself, and probably do it based on percentage of square feet.
Got it.
So just like home office deduction,
Mhm.
the home office deduction, they're pretty clear. Like if if you're in a one bedroom and you're trying to write off 50% of your apartment, the IRS doesn't substantiate that, though everybody wants to do that, you know? So you'd have to be pretty clear that that particular space is unoccupied when not filled with a short-term renter. If you can document that and prove that and take pictures and, just be clear, because the IRS is, as good as your claim is, if you don't have any documentation to back up your claim, then they'll come at you hard in that case. It's not
Yeah,
in that.
because I'm just trying to think of, let's say there's a lot of people who have like finished basements who, maybe have a garage that they've converted into, an additional living
That
space.
is the hack right there. House hacking is has a different connotation, but in a way that's short-term rental hacking that could reduce your wages, because here's the deal. If your short-term rental company, quote unquote, loses money, you're able to offset those losses against your W-2 wages. So it's a tax beneficial strategy to have a losing money short-term rental company, especially if you're a high income earner, because the 37% tax bracket
It
hurts
does.
bad.
Yeah.
So you imagine that any dollar reduction is a 37% gain at that point. Then having a short-term rental in your mansion, short-term rental business in your mansion, even if you fill it 7 days, 1 7-day stay, all the money that it took to keep that going as a percentage of your maintenance cares, as a percentage of the square footage of your home, you can mix in quite a few expenses into that 100% lawfully.
Yeah. I love that. That's a awesome, awesome thing to know. And I think that that's something that more people should try to take advantage of. But you did say, is this the last year that loophole is going to be available as of right now?
Great question. So the loophole's still available, but what makes loopholes so good is the accelerated depreciation.
Mm,
So
mhm.
accelerated depreciation ends this year. You'd have to spend, maybe if you go through us, it would be $3,000 to do a cost segregation study. And we'd ask you to walk through with the phone and on video, and we'd register what assets are in your home. So what type of roofing you have, what type of electrical you have, what type of air conditioning you have, what
Mhm.
type of heating you have, what flooring you have, things of that nature. So you do the cost segregation study, and this year the only benefit is 40%. So you can write off 40% of that asset, of each of those assets individually, and aggregate will be potentially less than 40%, because, as you mentioned, Mallory, the land you can't break off and depreciate. So you're looking at like maybe 30% of your asset could be written off this year alone. And imagine that as active income against your active income and expense against your active income. That becomes very, very appealing.
Yeah.
And then
Well,
next year, there's no accelerated depreciation. So you're just doing the 39 years for the multi-unit, or 27 and a half years for the single family
yeah.
investment properties.
So I think it's also important for people to know that once you've depreciated the asset, you can't keep depreciating it.
Well said. Well said. Yeah, yeah. So like if you took advantage of it in 21, so to go back to your question, let's say Magi happens,
Yeah.
and you get another 2 years of 100%. You do one and done 100%. You have a year of losing money in your short-term rental. And even if you had only one renter in there, you get that 100% depreciation. Next year, you can long-term rental it. You don't need to short-term rental it again every year and be a
Right.
hassle to you,
Mhm.
because you've already taken the benefits of depreciation. But the depreciation of a real estate property against high wages is a very beneficial tax move.
Mhm. Well said. Well said. I love that. Okay, so do you have any other strategies or tips that you think it's important for people to know when they're thinking about investing in real estate?
So I'm going to plug another business for a minute and go with the strategy I would with a startup founder. But in the case of buying a parking lot somewhere, a
Okay.
rural parking lot. Okay.
I
So we
love
call this,
parking lots, by the way.
yeah, I mean, active income. I mean, passive income coming in and low upkeep.
Hmm.
So imagine so we call this move the Peter Thiel. So Peter Thiel has billions of dollars in a Roth IRA, which will pay him out when he's 59 and a half in a couple of years. And now it's up to, I think it's $5 billion in his Roth IRA. He took low cost stock when it was worth a penny of PayPal and put it in $1,700 into a Roth IRA, which for those not familiar, you take after tax dollars in a Roth IRA and you get after tax, you get untaxable income in retirement.
Mhm.
So a traditional IRA, you take pre-tax dollars and then they tax you in retirement. So if you buy it, I think this year it's $7,000 is the max. If you buy a $7,000 parking lot in a self-directed IRA, you can keep it in your IRA and it'll pay you out when upon retirement or any of the depreciation plus income tax-free. So the one issue with that is 59 and a half years you have to wait. That's a tax-free gains approach, which we're working with startup founders to structure their startup exits tax-free.
Mhm.
So just wanted to play with that one a little bit.
Yeah.
Other than that, I mean, ultimately, there's energy tax incentives. The tax code is ever moving, ever evolving. The
Mhm.
short-term rental loophole is the sexiest one,
Mhm.
but it's definitely not the only one.
Yeah. I would say too, I think a lot of people are looking at potentially moving retirement money into a real estate asset. So you made a really good point with the Roth IRA. Like if you have a Roth IRA that has been building up, money over the years, you could potentially use that money to then fund the purchase of a real estate asset and keep that asset in your Roth IRA.
Well said, but you have to be self-directed. I think you can roll over from
Right.
a stock IRA into a self-directed
Right.
IRA
You're right.
and then use
Mhm.
those assets to buy. And the
But
self
for business owners and startup companies, that's the perfect option.
Well, 100%. So a self-employed IRA, SEP IRA, I think has a $60,000 limit this year, 60. So you could take that would be traditional money, though some people argue against that because the tax benefits of owning a home are so good and owning an investment property are so good. If you're putting it in a tax deferred vehicle, you're in a way losing out on those benefits.
Hmm.
So, but that said, if you were to have you could buy a home with a $60,000 down payment in a self-employed IRA this year. It would just have to be in a self-directed IRA account for that.
Right. Yeah. No, that's great. Okay, so John, you told us a little bit about some of your companies. I know you wrote a book. So what's the name of your book and where can people find that?
Yeah, check out LessTax US, lesstax.us. LessTax at proton.me is the email. Reach out to me. I can deliver you a copy of the book called Navigating the Tax Code to Riches.
Love
And
it.
it's basically, I'm a sailor. And I, like I said, came to the understanding that the tax code is not a booby trap. Nobody's out to get us. It's a tax code to enrich us and incentivize us to make the actions that make the country a better place.
Wonderful. I love it. All right, John, are you on any social media platforms that people can follow you and stay up to date on what you're talking about and see if your magical um, hopefully profit worthy thoughts come true?
Thank you. I've just evolved the less tax because I'm going to still continue to do that for select clients, but I've
Okay.
evolved it to at tax-free gains underscore US on Instagram and Twitter, and maybe TikTok if it stays. If TikTok leaves, it'll go away.
Right.
But at tax-free gains underscore US gets you to both places. And
Perfect.
the idea is that, yeah, structure, if you structure, you put a little planning. The thing about taxes is it's like a river. At the start of the Hudson River, it's just a trickle and just a little bit of water going through. And if you plan your tax savings at the start of the river, there's so much more available to you than if you come to me in April and
Mhm.
you're like, hey, let's do my taxes, get me the most I can.
Right.
I can definitely get you the most I can in that case. But in the case where we talked about the tax saving strategy, which is a great brainstorm, Mallory, I mean, there's a lot of very unique ways for you to save money. Have a tax professional in your corner, especially if you start, once you hit the $200,000 cap, it's beneficial to work with a professional and pay pay money to get the advice to save you money every year.
Absolutely. Well said. Well, Jon, thank you again for joining us on this episode of Inspire Wealth. Be sure to subscribe and like us right down below. And I am Prof M out. And for those who want a more hands-on learning experience, check out our online courses at inspirewealtheducation.com. Whether you're just starting out or looking to expand your investment portfolio, I've created step-by-step guides and resources to help you achieve your financial goals. So hit that subscribe button and let's start building your wealth one episode at a time.